Welcome to our channel. In this video we will be discussing the topic surviving inflation, strategies to protect your finances. Inflation is an insidious force that can erode the value of your hard-earned money over time. It's the reason why $1 today is worth less than $1 in the past. Inflation can be caused by a variety of factors such as increased demand for goods and services, a decrease in the supply of money, or a rise in production costs. Whatever the cause, inflation can wreak havoc on your finances if you don't take steps to protect yourself. In this video we'll go over some of the best strategies you can use to survive inflation and protect your finances. From investing in assets that appreciate in value to cutting back on expenses, we'll cover everything you need to know to keep your finances safe in the face of inflation. Understanding inflation, what it is and how it affects your finances. In simple terms, inflation refers to the general increase in prices of goods and services over time. When inflation occurs, the purchasing power of currency decreases, meaning that the same amount of money can buy fewer goods than before. This decrease in purchasing power can have significant consequences for individuals and households, making it essential to understand its implications. One of the primary effects of inflation is the erosion of savings. If the rate of inflation exceeds the interest earned on savings accounts, the real value of those savings diminishes. For instance, if the inflation rate is 3% and the interest earned on savings is only 1%, the purchasing power of those savings effectively decreases by 2% each year. This scenario emphasizes the importance of seeking investment opportunities that can outpace inflation to safeguard our financial resources. However, it is worth noting that inflation is not always detrimental. In fact, mild inflation is often considered a sign of a healthy economy. It encourages spending and investment, stimulates economic growth, and can lead to increased wages. Nevertheless, when inflation becomes excessive or accelerates rapidly, it can have adverse effects on our finances. By understanding inflation and how it can impact our financial well-being, we can take proactive measures to protect our finances. From exploring investment opportunities to creating a robust budget, being aware of inflation's implications allows us to navigate the economic landscape with greater confidence and resilience. The impact of inflation on your purchasing power. As prices rise, the value of each dollar you hold diminishes. This means that the same amount of money will buy you fewer goods and services in the future. For example, if the inflation rate is 3% per year, the purchasing power of $100 today would be equivalent to just $97 in 1 year. Over time, this erosion of purchasing power can significantly impact your ability to afford essential items, save for the future, or achieve financial goals. Inflation affects various aspects of your life, from daily expenses to long-term investments. Basic necessities such as food, housing, and healthcare become more expensive, putting a strain on your budget. Additionally, inflation can erode the value of savings and fixed-income investments like bonds, as their returns may not keep pace with rising prices. This means that if your investments are not growing at a rate higher than inflation, you could effectively be losing money in real terms. To protect your finances from the impact of inflation, it is essential to employ strategies that mitigate its effects. One effective approach is to invest in assets that have historically outpaced inflation, such as stocks, real estate, and commodities. These investments have the potential to grow in value over time and provide a hedge against rising prices. Furthermore, it is crucial to stay informed about economic trends and adjust your financial plans accordingly. Monitoring inflation rates, interest rates, and government policies can help you make proactive decisions. For example, during periods of high inflation, it may be prudent to allocate more of your portfolio towards inflation-protected securities or to consider adjusting your spending habits to adapt to rising prices. In conclusion, inflation has a significant impact on your purchasing power and financial well-being. By understanding how inflation affects your finances and implementing appropriate strategies, you can protect your wealth and navigate the challenges posed by rising prices. It is crucial to stay proactive, diversify your investments, and seek guidance from financial professionals to ensure your financial security in an inflationary environment. Historical examples of inflation and its consequences. Another notable example is the inflationary period experienced by the United States in the 1970s, also known as the stagflation era. The combination of rising oil prices due to the OPEC oil embargo and excessive government spending resulted in high inflation rates. This had significant consequences for the economy, with stagnant growth, high unemployment rates, and a decrease in purchasing power for consumers. These historical examples illustrate the devastating effects of inflation on individuals and the overall economy. Prices skyrocket, eroding the value of money and making it increasingly difficult for people to afford basic necessities. savings lose their purchasing power, and individuals find it challenging to plan for the future. Inflation can also lead to a decline in investment, as uncertainty and volatility become prevalent in the financial markets. Understanding these historical examples serves as a reminder of the importance of implementing strategies to protect one's finances in times of inflation. By being proactive and taking appropriate measures, individuals can safeguard their wealth and mitigate the negative effects of inflation on their financial well-being. The importance of diversification and protecting against inflation. One key strategy is diversification. Diversifying your investments means spreading your money across different asset classes, such as stocks, bonds, real estate, and commodities. When one asset class is affected by inflation, other asset classes may perform better, helping to offset any losses. By diversifying, you can potentially reduce the overall risk in your investment portfolio. Different asset classes have different risk profiles, and they tend to behave differently under various economic conditions. For example, during periods of high inflation, commodities like gold and silver often perform well as they are considered inflation hedges. Additionally, diversification can also help you capture potential growth opportunities. By investing in a variety of assets, you increase your chances of benefiting from sectors or industries that may outperform during inflationary periods. This can help mitigate the impact of rising prices on your overall financial health. It's important to note that diversification does not guarantee profits or protect against losses, but it can be a valuable tool in managing the effects of inflation. To effectively diversify your portfolio, it's advisable to consult with a financial advisor who can provide guidance tailored to your specific financial goals and risk tolerance. In summary, diversification is a crucial strategy to protect your finances against inflation. By spreading your investments across different asset classes, you can potentially reduce risk, capture growth opportunities, and safeguard the value of your money in the face of rising prices. Investing in assets that outpace inflation. When inflation rises, the purchasing power of your money diminishes. This means that the value of your savings and investments may erode over time if they do not keep up with or surpass the inflation rate. By investing in assets that tend to appreciate at a higher rate than inflation, you can safeguard your wealth and potentially even grow it. One popular asset class that has historically shown resilience against inflation is real estate. Investing in properties, whether residential or commercial, can provide a hedge against inflation. As property values tend to rise over time, the returns from real estate investments can outpace inflation and offer a steady income stream through rental payments. Another asset class worth considering is stocks. While stock market returns can be volatile, historically, the overall trend has been upward. By carefully selecting stocks of companies with strong fundamentals and growth potential, you can potentially earn returns that outstrip inflation. Additionally, dividends from stocks can provide a consistent income source. Commodities such as gold and silver have also been considered as inflation hedges throughout history. These precious metals have intrinsic value and tend to hold their worth even during times of economic uncertainty. Investing in physical gold or silver, or through exchange-traded funds, ETFs, that track their prices, can be a strategy to protect your finances from the erosive effects of inflation. Lastly, consider diversifying your investment portfolio across different asset classes to mitigate risk and maximize potential returns. By spreading your investments across stocks, bonds, real estate, and other inflation-resistant assets, you can increase the likelihood of preserving and growing your wealth. Remember, investing always carries some level of risk, and it's essential to do thorough research, consult with financial advisors, and consider your individual financial goals and risk tolerance before making investment decisions. However, by strategically investing in assets that have historically outpaced inflation, you can take proactive steps to protect your finances and navigate the challenges posed by inflation. Thanks for watching our video. Don't forget to like, share and subscribe to our YouTube channel and press the notification button for the next video.